Okay guys, good morning. Hope you're all well. So looking forward to the day ahead, and let's just look back though. Pretty remarkable session, it has to be said. In terms of just the scale of the turnaround we saw in a lot of these key markets, some extraordinary candles printed. If we just bring up and enlarge the S&P candle here, the S&P chart, and look at the daily candle yesterday. Rarely will you see anything like this. The range for the day was 40 points, with a massive monster move to the downside, of course. But then by the time we got to the close, all the way back at new highs, and actually the S&P index finished just positive for the day, 0.2% higher, having been 1.5% and more to the downside when we hit the low. And what was important about this move lower, and we'll zoom in and look on the shorter term chart in a minute, but we broke down below the low point that we had on the 27th of July and went down, and in the end below 2050. And actually this briefly took the S&P into negative territory for the year. The index opened for 2015 around about 2052. So briefly yesterday, here we are midway through the 8th month of the year, and still this market has failed to add anything to the upside, but then equally it's failed to actually drive or sustain any move to the downside either. So pretty interesting. We'll talk about this a bit more in a sec, but just one thing to note. Now, Deutsche Bank had come out with a stat this morning. They didn't really explain exactly how they quantified this, but they're suggesting that I've moved to a monthly chart here just to look on the longer term. And if I zoom out, just to kind of talk about this scenario, just how this market's been behaving. If I just draw a bit of a circle just to pinpoint 2015, and Deutsche Bank reckon that this is the tightest range this index has traded in since 1927, apparently. So we got like a 90-year record being set here for the S&P trading in such a tight range for such a long time. Now, they didn't give any information, so I don't know over how many months they've measured this, but I'm presuming back to March. So March, April, May, June, July, and now August. This index has been confined within about 100 points. It's about 110-point range that we've got here for now 6 months. And so this, I presume this is the range they're pointing towards and suggesting it's a 90-year record. Whether that's accurate or not, who knows? I mean, I don't have the ability to go back, or indeed the time or the inclination to bother to go back and check whether this is right over the last 90 years. But the point they're making is that this is a remarkable range for such a long period, 6 months, and still this market can't get anything going on either side. And I guess yesterday kind of summed that up in one session. Really strong move to the downside. That's off the back of a strong move lower the day before, of course. But ultimately, by the time we wind up at the close of the US session, the market's back into the middle of this tight range. So, of course, yesterday the momentum to the downside generated by mostly China, and still just the fallout from this currency move. And we've been talking about this move where the Central Bank of China have devalued the yuan, and it's a hard one to judge what their motivations are, and it's hard to judge how far this currency can depreciate at what speed, and it's therefore hard to judge what kind of ramifications that carries for, let's say, other Asian economies, what kind of ramifications it carries for the likelihood of the Fed raising rates in September. It's a pretty difficult one to judge. Now, what happened yesterday, I think, and the rebound may well have been as a result of China. I mean, let's go back to Tuesday. So China will tell you that this is that their devaluation of their currency is all about them opening up this FX market, allowing the exchange rate to be driven by market forces, and therefore paving the way for the IMF to recognize it as a funding currency and for it to be introduced into the SDR and for the yuan to sit alongside the dollar, the euro, the yen and the British pound. Okay, it's all part of the modernization and the opening up and evolution of Chinese markets, all right? And so this is, the China will say this is why we've done it. And so what they've done, of course, on Tuesday was when the central bank fixed the exchange rate at the start of the session, they said that we're going to fix it 1.9% lower, and from now on, the value we fix the exchange rate at will be based on where the market closed the day before, amongst other factors. But for the first time, they are using yesterday's closing price, i.e. the closing price determined by market forces will then play a large role in setting the FX fix at the beginning of the following day. So 1.9% drop on Tuesday. Okay, then the fix on Wednesday was at 1.6% lower than the day before. And then today we've seen them set the price at 1.1% lower than the previous session. So we got a 1.9% drop, followed by a 1.6% drop, followed by a 1.1% drop. It's just yesterday was a pretty interesting day because at one point the exchange rate was down 2%, but by the close it was only down 1%. Now it looks like China have been in the market selling dollars, propping up the exchange rate and actually driving it back higher to force a closing price that was higher than actually market forces would have set if they were left to their own devices. So you've got this kind of scenario where it's like 2 steps forward, 1 step back with regards to China opening up their markets. They are allowing market forces to play a larger role, but if these market forces drive market movement they don't like, well then they're back in the market intervening. So this is kind of what happened yesterday, and I think maybe this calmed the nerves a little bit because people are worried about a rapid accelerated depreciation of the yuan. And if the central bank are in the market just to kind of control it and make sure that it doesn't get out of hand, well then perhaps this settled some nerves yesterday. And so maybe this helped with this reversal. A lot of the sell-off, of course, was as a result of the panic that this indicates that China's economy is performing a lot worse than we thought. You know, all the monetary policy stimulus response of the last sort of 8 months, and it's been an extreme set of interventions, hasn't been enough, and they need more. You know, bad export data at the start of the week, triggering this decision to go with yet more stimulus using a new avenue. You know, fears about this sparking a ramp up in the currency war situation across Asia. And, you know, what you saw was, if you look at the DAX, which is the index on the right-hand side of my screenshot here, Tuesday the DAX was down 2.7%. Yesterday, by the time we got to the close, it was down 3.15%. So the DAX getting hammered. The likes of BMW, for example, share price down like 5% off the back of this because of the implications this carries for European exporters selling products in China. Also, the commodity space generally weakened, commodity companies weakening as a result of the idea that if China's currency is cheaper, they're not going to be able to afford as much. So less demand for commodities. You know, this is the kind of theme that drove that 1.5 day risk off. It's just that by the time we got to the end of the US session yesterday, fears had calmed. You could say the 200-day moving average played a role, maybe, for the S&P in kind of propping things up. But if you look at a couple of other charts, I want to show you the. Sorry, one sec. The other phenomenal candle. Hang on. Was the T-Notes candle. This is the daily chart for T-Notes. And these are just remarkable, these kind of pictures. But big move higher for T-Note prices yesterday initially as we priced out a September hike. It dropped to 40% likelihood at one point yesterday. But by the time we got to the close, it reversed a whole lot. I mean, if you ever wanted a reversal candle, well, you know, you're going to struggle to find one as powerful as this. So by the time we got to the close, we're back up to a 44% chance of a September hike now. One other market that's been a big beneficiary of this little panic over the last few days has been gold. This is the gold price driving strongly higher, 5 days up in a row. That hasn't happened for a long time for gold. Climbing, well, we're back up above the 1,120 handle, I should say. So gold benefiting. Look at this VIX chart. I spoke about the VIX, was it yesterday or the day before? This is looking at the VIX this week. We traded down around, almost sneaked down to a value of 12 at the beginning of the week. And 12 is that kind of long-term low over many, many years. You know, rarely is this gauge gone below 12. But look what's happened on Tuesday and then yesterday briefly. We ramped up to almost 16. So, I mean, in percentage terms, that's a move from 12 to 16. That's a 30% move higher on the VIX as the fear began to build. But look at the dramatic reversal on the VIX yesterday as well. By the time we hit the close, back down to 13.6. So you got a remarkable session yesterday. Firstly, continuation of Tuesday's panic and risk off, followed by then just a phenomenal rebound, showing that, yeah, there's concern out there, but still these bulls, especially with the kind of, I guess on the US side of things, are still there. They're still in the market. They're still not prepared to allow this index to turn negative on the year. But if you look across at Europe and look at the DAX, you know, you're still, I mean, yes, okay, we've opened higher and the market's 1% up on the day, but we are still only at the midpoint of yesterday's range, and we're still miles off. I mean, miles off Tuesday's high. We're up at 11,500, so we're still a full 500 points below Tuesday's opening levels for the DAX. So I think whilst the US markets delivered a pretty remarkable turnaround, I think that for Europe it's still been pretty ugly. We are still substantially lower off the back of these developments. Now, maybe some of the Greek developments yesterday helped with the smaller rebound in Europe. So this is where Germany have just flagged up to some concerns about this deal that is being, trying to be finalised, of course, in Europe. That's the Greek bailout programme. And so Germany voicing some concerns about the kind of detail. We've got a finance ministers meeting on Friday, which now is probably going to be pretty interesting. So let me just get a couple of comments. So Merkel's spokesman said about the deal, it goes in the right direction, but it's not possible to say whether or not it's ready for a vote through the Bundestag. The problem is we've got, and this was reported in the Greek press yesterday, that the deal's done and it's ready for voting through Germany's parliament. But you've got Germany saying, well, we're not quite sure about that yet. We've got a 20th of August date in the diary. This is when Greece has to pay another bill to the ECB, and at the moment it looks like they're going to have to resort to a second bridging loan deal, because it looks unlikely now that we're going to get this bailout voted through respective parliaments and, you know, delivered by then. There's a few things in this deal that Germany aren't happy about. Things like, well, what's the role of the IMF? Are they involved? We actually don't know. I mean, this is the crazy thing. To think that this deal's almost done, I think forget that. The IMF, whilst they've sounded positive about this deal, have yet to actually say whether they're going to participate in this bailout or not. So it's an 85 billion euro bailout, but, I mean, are the IMF contributing? That's unclear. And if they're not, well, that's going to be a tough sell in the Bundestag, I can tell you. I think Merkel's going to struggle to get that through the Bundestag if the IMF are not involved. The only problem is, for the IMF to be involved, there's probably going to need to be debt restructuring, and that's something Germany aren't happy with. So you've got a bit of a standoff there. The other things, it's like the privatisation programme. So Greece have agreed that they're going to basically put 50 billion euros worth of state-owned assets into a fund that's controlled by Europe, and that they sell off these assets, raising 50 bill. Okay, the only problem is, apparently, all this deal that's been agreed upon this week, the detail on this privatization fund is that, well, we'll just set up a task force and we'll try and get this fund set up by the end of the year. Now, for Germany, that is not good enough. You know, forget about task forces and, I don't know, at the end of the year at some point. No way. We need that detail that's happening, and we need timelines. So I think this Greek deal, whilst we had positive noises about it earlier in the week, took a turn for the worse yesterday, with Germany voicing concerns. So perhaps that certainly contributed to maybe equities not rebounding as much in Europe as they did in the US. But look, if I go to the 1 hour chart, you can just see the DAX is actually right now sliding, closing the gap, and now moving lower. So we're making new lows for the session here on the DAX as I speak. Just thinking about things like the euro dollar yesterday, and in fact this week, euro dollar, 6 up days in a row, with yesterday's being the most powerful. Break out of this 2-month downward trend line, big move up, briefly above the 112 handle, hitting the July top at 112.27, and then turning, and we're under pressure now as I speak, just testing the high point we had on the 31st of August here. What turned out to be, well, we've had dollar weakness really over the last couple of days. As we've had this risk-off scenario, we've actually had dollar weakness of the idea that this China move is going to prevent the Fed from hiking rates in September. But with the rebound yesterday, this Fed rate hike is the probabilities rising again, and so this is perhaps leading to a bit of dollar strength in today's session, reversing some of those earlier moves. Crude oil then, of course, very important still. Yesterday, actually unchanged on the day. We flirted with making a test of the low point we had on Tuesday, but in the end it held up. We got a nice doji on this daily chart. But is this the bottom? I think it's a brave man who calls that. I don't know yet. It's I don't know. It's so uncertain. I think technically it's still very, very negative. Of course, we've absolutely got no reversals here, unless you want to point to that little doji. But maybe that's not powerful enough on its own to get confident about a reversal. If we are going to see some dollar strength come back in, off the back of the idea that actually maybe the Fed will hike in September, that might keep prices lower. But the inventory data yesterday was, well, it was kind of mixed. On the one hand, you got a drawdown on inventories, but then on the other hand, you got a drop in production. So that was kind of mixed, and that's why I guess ultimately we had a doji. But the energy space still right down there at the lows. Yes, we've bounced, but come on, we're only 80 ticks above the low of what's been more than a 30% sell-off. So, and yet to test the $42 handle, which is the low of the year set back in March. So it's still, well, if you look at this picture, fundamentals, it's difficult to kind of sift through it all. There's so many different factors you've got to think about. China maybe top of that list. China demand, future demand weak because we're worried about economic activity. The yuan devaluing, well, that makes it more expensive to buy oil. So that side of things is negative. Except you've had a few drawdowns in a row now on US inventories, and so maybe the US supply side situation's turning, which is a positive. So it's a difficult one to judge, but then at the same time you've got record output from Saudi Arabia, Iraq, we've got Iranian crude coming online later in the year, so it's a real mixed bag of fundamentals here. So just looking technically, well, it's a no-brainer. It's still heavily negative on the technical front, and we're so close to $42, it'd be surprising if we didn't test it, but we'll see. So I think it's too early to call the bottom here. So it all makes for an interesting session ahead. Let's have a look at the calendar. We've already had some inflation numbers out of Europe this morning, which I guess in the end were fairly uninteresting in that they all delivered numbers in line with expectations. So Germany and France coming in with, this is final readings for July. So CPI on a month-on-month basis plus 0.2, and an annualized basis plus 0.2 for Germany. France minus 0.4 and plus 0.3 respectively. These were in line with expectations. Spain were actually slightly better than expected, so slightly higher. So on a month-on-month basis, minus 0.9%, year-on-year plus 0.1%. Okay, so we've got through that data. And really that's it for the morning, I'm afraid, in terms of data flow. So definitely the big event of the day is the retail sales figures out of the US at 1:30. Before that, at 12:30, we got the minutes from the meeting, the ECB monetary policy meeting 3 weeks ago. But, we have press conferences after these meetings, so it's hard to judge what kind of more information we can get out of these minutes. So we'll see at 12:30, but maybe these won't be particularly influential. So it'll be retail sales that's the big event of the day. And we're expecting plus 0.6% for July compared to June. That's on the headline. We have ex-autos number, we're expecting plus 0.4%. Ex-autos and gas, we're expecting plus 0.4. Okay, if you have a look at the chart here, on a month-on-month basis, it's been a mixed year. Really negative into the end of last year, start of this year. Big bounce in February's reading, plus 1.5%. And then mixed. I mean, really, it's a bit of a mess. Now, today we're expecting plus 0.6%. There's no obvious trends or patterns to get out of this picture, so it's a difficult one to judge. But plus 0.6% is what we're expecting. But this data has been notably underperforming this year. Okay, more often than not, it's delivered much worse than expected numbers. So we'll see if we get the trend bucked or not. If you're looking on an annualized basis, well then the picture tells the story in that we've trended lower. Look at last year's figures, upwards of 4% annualized retail sales growth. It's just collapsed this year. So it's still looking pretty weak, and perhaps this is just due to that lack of wage growth scenario. So these will be the headline figures for the session, definitely. But these aren't coming till 1:30. All right, so I'll leave you to it for now. Just a little bit of weakness on European stocks here, having opened higher. The S&P is still trading up above yesterday's high, so you're not really getting any weakness on the US side as we speak. So let's see how we go through the session, but the highlights at 1:30. All right, enjoy the day. Thanks.